So we've covered a broad range of subject matter here. We've heard from the academic perspective, from the private sector perspective, and from the government policy perspective. Now we have an opportunity to try and sort of tie it all together and maybe drill down a little bit more on some of the points that were raised earlier. If I could start with a first question for Casey. I know you've been very involved in helping to develop Hong Kong as an offshore renminbi center. We're now seeing, as we heard earlier, other locations getting more active in the market: Singapore, Taiwan, London, perhaps Switzerland going forward. What do you think is going to differentiate Hong Kong from these other places as this market really starts to take off in more locations?
Well, I think the number one, we actually welcome all the centers offering RMB services. It may sound strange, but I don't think Hong Kong can succeed on our own, trying to get its market for, to reach out to the world. So we need other people to come in to participate. Obviously, we cannot, reach European clients from Hong Kong alone, time zone difference and so on. And of course, Taiwan and Singapore offer their own markets. So that may sound very good, political correct statement. But I think there's some truth in there. But let me say this: the two things I will make. 2 points I will make. One is that Hong Kong is a beneficiary Hong Kong will be the first and foremost a major beneficiary of any policy of opening, because we are right in the middle of the action. I think Hong Kong banking sector, the kind of trade that we're already doing with China, will ensure that Hong Kong will receive the major portion of that liquidity. And so that's number one. And the access to the Chinese market, the access to the Chinese regulators, the policymakers, the relationship between the Hong Kong government and then the central government, I think that is not to be underestimated. But there's one more thing I want to say. I actually love competition. And I don't want Hong Kong bankers to be too lazy. I want them to really compete for business. So when they see the Singaporean, going for RMB business and Taiwan offering RMB services, I want Hong Kong bankers to be working very hard to do it. So from our standpoint, more people coming, to join the party, the better.
Great. Chi-Wan, if I could turn to you. We heard a little bit from Tommy earlier about QDII and how that market is developing. But could you talk a little bit more about what you think the opportunities are as more channels open up for outbound investment for ordinary investors in China?
Sure. I think Tommy did a very good job of summarizing what happened in that space. QDII originally was introduced sometime in 2006, and I think it was in some ways a little bit unfortunate that it got started right towards the peak of the market cycle, and it got caught in the downdraft of the 2008 great financial crisis. And as a result, I think the actual experience of QDII investors in mainland China was mixed. And as you saw in the NAV numbers, it was all mostly below 1. Add to that, I think China had, there was great expectation of RMB appreciation. So I would say those two factors combined made QDII perhaps less popular than one would have expected. But I think as the exchange rate trend becomes less one way, particularly about the strengthening of RMB, and as other investment opportunities such as recovery in the US and the like actually picks up, I would imagine QDII will actually become a real viable alternative. And I think it does offer meaningful diversification opportunities for Chinese investors. So my bet would be that that in due time, it will recover and do very well.
The flip side of what you're talking about with the renminbi appreciating no longer being a sure thing that it was, is that we're seeing yields in the CNH market start to rise. Dim sum bonds, which used to have these extremely low yields, in the face of this huge demand, have now pushed quite a bit higher, much closer to the onshore rate. Tommy, can you talk a bit about how that reflects the demand from international clients generally towards China, and how much concerns about slowing economic growth, incidents like the interbank credit crunch that we saw recently, might be playing a part in their appetite?
Sure. I think, so simply put it, we have seen consistent demand from our international investor base, despite the fact of volatility. So for example, we do see this seasonal sort of allocation between developed and also emerging markets. So for example, last year, probably August or summer was the low point of emerging market demand, as well as China. And then Q4, with the reallocation to emerging market, actually the overall international investor demand picks up. And looking back for the past 2-3 weeks, we definitely see some cautious and nervousness across investors. We've seen investors taking more cash positions than equities, but they're not, from a quota or investments perspective, they are really holding on and waiting for a better entry point to get into it. So overall, we have seen clients very much focus on, for example, how MSCI and also FTSE will consider China Asia to be included in the broader base index. So that would definitely really affect their benchmarking and the tracking, and also increase their investment.
Great, thank you. I'd like to open this up to questions for the audience. So if you have a question, please raise your hand.
I have a question for Professor Chen and Tommy Fang. The QV scheme has been running for 10 years now. So how would you assess the QV scheme from a policymaker's perspective, as well as from an international investor and market participants' perspective? If it's a success, what are the factors contributing to this success?
I'll start off. You can provide much better advice. The way I look at the QV scheme, I think it's really a process of maturing, as well as getting broader and broader policy approval. I think initially the QV was allocated to some institutions, right? Either for the fund management or for the own in-house trading, which is fine. At least the way that I see from Hong Kong perspective, how I can use the QV scheme is how do I get the retail investor to participate in the QV? And which is why one of the major things that we actually lobby for was of course later on granted under the RQV, the ETF, the ETF scheme. For us, the ETF scheme under the QV or RQV is the kind of product that we want to promote, because getting it's not just having the investors, foreign investors, being able to participate in the Chinese market. Where we would like to see is that people using Hong Kong platform to get in the Chinese market. So having an ETF product traded in our market will allow both investors in Hong Kong as well as other investors, to participate in the Chinese market. And I think the more, when you have active turnover in ETF products, it generates excitement, it generates interest from the investors. So and also good for our stock exchange. So I see that it is in Hong Kong, in the Hong Kong situation, when we get the ETF launch in Hong Kong, the retail are excited about it. We have more interest in the renminbi products as a result. So that would be a great development for us. And also the RQFII quota so far is really it's a quota granted to either a fund management company or either for their own in-house trading or to the fund management companies to package as ETF. So currently everything is still under a controlled mechanism of distribution, either through an ETF or through some kind of fund products. And that's a way the Chinese regulators want to regulate, how the money from overseas can come into the domestic market. So currently QFII has that feature. It's very much controlled. And I think to have an ETF product in the retail level to get excitement is definitely a better way than earlier phase. Of course, the next thing, as we would like to see, which is what Tommy mentioned in your slide, is getting individual investors to basically participate directly in the Chinese market using some kind of QFII. So that would be a next stage that we're hoping to open up.
Yeah, I think I definitely agree. I think from my understanding of the market, so for example, you have two key regulators for QFII regime in China, and the CSR and their objective or policy objective are relatively different. So from CSRC's perspective, they're very much focusing on the healthy development of the stock market or the listed capital markets, and so their focus are more on what type of investors coming in, and increasingly from my interaction with some of the leaders. So they are getting more towards the view of no regulation probably would be a better solution than regulated in a wrong way. So I think that's my observation. But from SAFE perspective, which grants quota, so they have more different concern, more from, as the professor mentions, more on the Renminbi globalizations, how the PBOC and the government want to manage the bank balance of payments. So their concerns are relatively different. So therefore, sometimes the regulators, they also need to make sure they are in sync into the objective. From the market participants' perspective, obviously it's a great success for a lot of the early participants like ourselves. And what we definitely wanted to see is more relaxations and more market participants. Professor Chen mentioned individuals, and actually, for example, large investment community like hedge funds, they're very much interested in the China markets, but they are relatively excluded into the QFII scheme. So if more liberalization to include more market participants into the market, so we believe it will be more dynamic and more efficient.
On that subject, if I could just ask you, Tommy, what from a client's perspective, what do the clients want to see most from the regulators? And I realize we do have a few representatives from Hong Kong regulators in the room, so it's a slightly tricky question to ask. But nonetheless, what do you think they're looking for in terms of possible changes to the QFII scheme?
Sure, I think one of the best answer I've heard is actually from one of our partners. I think she mentioned that the global investment community. So they have three top wish lists. First, they hope that the opening or the granting of quota are transparent and consistent instead of relatively patchy, depending on how market moves or how the inflow outflows, and then they dictates. And second, there's more detailed in terms of, for example, capital repatriation. So currently, for QFII, so other than open-ended funds, so most of the QFII, they have only a monthly window to repatriate money. And also, the last one is also related to repatriation, is also the tax treatment. So how the capital gain tax, if there's any, being treated. So those are the issues will definitely make global international investment community more interested to putting efforts hiring people, build an investment team, apply quota, and invest China in long term.
Thank you. Any questions? If not, if I can,
Question to Professor Casey Chen. Can you share with us the plan, the government plan to further grow the wealth management business and how to position Hong Kong as the wealth management hub in Asia? Because earlier you highlighted the focus for Hong Kong is to grow the wealth management and the fund management business.
Okay,
thank you.
Well, one of the most important things is talk to the wealth management industry. Okay, I mean, usually I think the best advice is to talk to industry and try to figure out exactly what we should do and whether any bottlenecks and how we should deal with those bottlenecks. And I think in fact it's one thing that we have done with UBS and other firms in Hong Kong, and we have that discussion. And that having a dialogue between the regulators. I'm a policy side, but having a dialogue between regulators and then the wealth management side of the industry, so that they have this, work out the regulations, the right kind of regulation. And second thing that we think is very important, and I admit that we haven't done as well as we should, is to promote the industry. I think we felt that we have not done enough to promote the industry, to give the identity. People always mention about Singapore experience in promoting it, and I think there's a lot for us to take note of. There isn't anything that there's no magic formula, or the experience of other countries may not be able. We may not copy wholesale to Hong Kong, but clearly there's it does talk about the right kind of promotion of the industry is important. The promotion of the image of industry is not only good for getting the clients to come in, to leave the money here to be invested. It's also good for promoting, getting the talents to enter the industry. I think that sort of image building, I think, is very useful. In that regard, I know that we are working with the industry to try to come up with some plan. Also industry association to promote it. There are some of the things that we can do more. We have done so is to look at the tax side. What are any disincentive in terms of tax. We also believe that the major breakthrough is of course the Chinese market. How much access we can get into the China market. Some of the wealth management activities is already taking place in Hong Kong without a policy help. Okay, a lot of Chinese investors are in Hong Kong anyway. So the question for us is how do we get more of those who are now unable to come to Hong Kong and tap into our services, and how do we get these investors to use Hong Kong? That would mean some regulation breakthrough. And we're talking, of course, to the Chinese regulators. I mentioned earlier in my presentation about the mutual fund recognition. If we can do that, then we can sell our products manufactured in Hong Kong directly on the mainland. That's the kind of thing that we're working on. And back to my first point I make, talking to industry always very useful. So I will continue my dialogue with the industry to see what we can do more.
Other questions?
How do you see, probably for Professor Chan, how do you see the offshore RMB lending market impacting loan-to-deposit ratios for the Hong Kong banks over time? Or perhaps how would you like to see the RMB offshore lending market impact them?
Now, if I get a question, I think the answer is very simple. We basically look at the bank regulators will look at the bank lending practice either by itself, without caring whether it's an offshore RMB or Hong Kong dollar. So I think we should apply the same standard to the banks, whether it's risk management or lending management. So So I think, in fact, if one thing I do know is that we pay a lot of attention to the interaction between Hong Kong banking sector and the mainland. It's nothing to do about offshore RMB. It's just, currently Hong Kong banks have exposure onto the mainland, even before the RMB internationalization. So it's the way that we, of course, asking the bank to manage the risk is to look at the adopt all the kind of risk management practice. And sometimes when we see that there is high loan growth in exposure on the mainland side, the banking regulator will ask questions. We will ask questions so that people will put in place the right risk management practice. So it's nothing to do with really RMB. It's basically doing the right ABC of a bank risk management.
I'd like to get back to a question that I think we asked at the very beginning. In fact, I think, Chi-Wan, you raised this, so I'm going to throw it back to you. China's leadership has said on numerous occasions that it does intend to move towards full opening of the capital account at some point in time. And recently, they've reiterated that statement, even had the State Council coming out and saying that they would set a timeline for doing it. Should we take them at their word?
Yes, just as a caveat, I think Professor Casey Chan is probably better placed to answer that question. But let me just give you my observations. I have certainly had a lot of dialogue with some of the regulators in China, and the short answer is yes. I believe they're very serious about it, but I think it'll take time, just like anything else. I think the two academic speakers spoke very eloquently about what is required to have an open capital account. A lot of these financial reforms have to happen in tandem, so liberalization of the exchange rate, the interest rate, and the like. So I think it's fair to say that the leadership is quite serious about it. They're doing, in my opinion, a great job of laying the groundwork for that to happen. And clearly, as Professor Casey Chan mentioned also, there is an acceleration of their intent in trying to liberalize the markets. But once again, I think China will open up their accounts when it suits China. It's not going to be, muscled into doing it by anybody, right? So I think they'll be thoughtful, and it'll be very well planned, well synchronized, and they'll execute one at a time. That would be sort of my take on the situation.
Mm-hmm. Thanks, Chi-Wan. Casey, do you want to add anything to that?
No, I agree. I absolutely agree. I think that when I make my remark, I am making my remark in terms of perhaps how the discussion got intensified over the last couple of years, especially I think with the steps that were taken to push the RMB, to the international arena. I think that is, beginning of the process of really seriously looking into this question. Mm-hmm. It does, and if you look at the 12 5-year plan and so on, all the pronouncements made by the Chinese leadership, I think it's very clear that they recognize that this is the goal. And there's even timeline somewhere out there. Of course, even with timeline, you can always define exactly what you achieve in each milestones. Because what is the meaning of a basic convertibility? There's all kind of convertibility you can actually manage. So convertibility may not be full convertibility. So I think there are ways for them to. There are many potential milestones that they will hit before you see perhaps some full convertibility. But I think that this, barring for some unforeseen circumstances, and I think that I do feel that there is a stronger commitment to this whole process.
And Fabrizio, Michael, I'm going to ask your perspectives too, having elaborated on all of the various issues that they're going to have to tackle along the way.
Yeah, I cannot be suspected of having inside information, so I'll look at it from an outside perspective. So it seems to me that while in academics sometimes we like to discuss in binary ways, 0, 1, so capital, full convertibility, not full convertibility, so in which year and when. Sure, there is a process that converges to something, but what I expect is that they will play more on the timing of this expansion of the current instruments. So these qualified investor programs. And I mean, if I were called to do an advice, I would say try also additional instruments, like using, for instance, the pension funds that China is building up. This is still a very low capitalization, but it's up to the authority to decide to increase its capitalization. The resources are not missing. And now, of course, one could take a perspective of giving some independent authority the possibility of using this, again, not only as a vehicle of ensuring old age program, but also to promote further internationalization. And certainly, I think the way Norwegians are using their oil funds, there is some similarity here. And I would also push perhaps this back to my one of the slides I presented, this idea of pushing further the securitization of the renminbi by creating additional vehicle like mutual funds with large participation also in terms of equity from the Chinese savers, because at some point this has to become also something people are familiar with. And I guess that this issue with the QDII program having entered somehow the wrong moment, it becomes less and less of an issue as soon as people feel that this is something they understand. We always discuss, for instance, in terms of the international puzzles, this home bias puzzle. We don't understand why people like to invest so much in their own country and in their own currency. Well, here I guess it's a similar point. People are not familiar with this way of investing, and probably if I were to advise in terms of the acceleration, I would do precisely by thinking of more instruments that can create the condition for which, at some point, I think all these issues we're discussing in the first part, the convergence also in the interest rate will happen as a matter of market pressure. And then at that point, the step of declaring full convertibility will not be a big step. Now it's probably a big step. If we do it tomorrow, we don't know. Probably I don't know in this panel, and probably Michael doesn't. I don't know, the gentleman, what would happen to the renminbi tomorrow if we did it sharply. But once the convergence has come, and it can happen also not in a matter of 20 years, but it could happen in a matter of 6, 7 years, then I think that there will be much less uncertainty.
Sure. Michael?
Right. It's there's always a kind of big question to me. What does it mean, full capital account liberalization? So I don't think we have reached a consensus on that. For instance, even if we reach kind of full convertibility of RMB, whether or not some kind of a quantitative constraint will continue to be imposed on investors, just like quota imposed on QFIs, this is a kind of big question mark in my mind. So the related question is, in the end, if you have a fully liberalized capital account, you theoretically speaking, you have to have a kind of a flexible exchange rate regime. However, given the volatility of interest rates that we have, probably we need a huge magnitude of exchange rate fluctuation to adjust the difference of interest rate across the border. So whether or not the Chinese regulators would like to see that, to what extent they would like to accept the big fluctuation of exchange rate. So that continues to be a kind of a big question in my mind. So I'm not so sure, even if they set up a timeline for this whole process. So what does it mean? Capital account liberalization. So I don't know, but I'm quite sure that in the long run that has to happen. One comment I want to add to this discussion is this is actually pretty much related to the shrinking labor force in China. Last year, for the first time, since the data, statistical data become available, we see shrinking labor force in China. In a period when we have a growing labor force, of course, capital returns are set to be quite high. So we don't actually need to invest abroad. We just invest in domestic markets. We can enjoy high returns. But in the long run, when the labor force is shrinking over time, the capital returns are set to fall over time. So at some point, probably the domestic returns, investment returns will be actually lower than the world level, especially when the US economy is picking up. So at that point, this is also related to Fabrizio's earlier comment on pension investment. In this aging society, in an economy in which domestic capital returns are lower than the world level, then probably we really need to invest money abroad. In that case, a full capital account liberalization is really needed for the future, for the welfare of the Chinese people.
Great. Thank you. Any last questions? If not, I think we've just run a little bit over, so we did pretty well in the end. Thank you, everybody, all the panelists, for your excellent contributions, especially KC for making the time to come and join us today.
Yep.
Professor Zilibotti, Zheng Song, Jiwan, of course, Tommy, thank you all.
Thank you.
Good.